So kind of neutral sentiment coming through from the survey for the first quarter, but it looks like where bonds have made up, equities have lost out during the quarter.
Yeah, I don't know that equities have necessarily lost out that much, but they just simply haven't gained. And it's very much symptomatic of the kind of market we're trading in right now, where discussions we've recently had with fund managers has revealed that there's no real conviction one way or another as to where these equity markets are likely to go to. And I think as a result, there has been some sort of a default, if you like, back towards bonds. And bonds have continued to increase their weighting. And it's been the highest weighting for a number of quarters now. So investor confidence improving ever so slightly, but nothing really to get excited about, and suggests that at the moment there's still a huge amount of uncertainty out there.
What does the move back into bonds by fund managers tell you about their views on inflation going forward, George?
Well, it's an interesting question, that, because if you speak to many out there, you'd believe that inflation was certainly going to rise, and rise quite strongly, and so bonds aren't really the asset class that you would prefer in such an environment. Yet you have a look at how the bond market's been performing recently, and if anything, it's been clawing back some ground. And I suspect that with all the uncertainty that's happening both domestically and internationally on the economic front, the reluctance to head back into equities has seen some investors rotate cautiously into the bond market out of cash. So there's still a significant amount of cash available to rotate out of, but it's clear that they're not rotating into equities. So if you're trying to extract a little bit more in the way of yield, you would tend to default back towards the bond market, which at this point is not performing as poorly as many people had anticipated.
How about international equities? Because we do have the rand still sitting quite strong, and we had Treasury last year increasing the offshore allocations. Have investors been taking advantage of this in your view?
Well, I think if you have a look at the fund management industry as a whole, there was, through the course of last year, a fairly significant shift when the allocations allowed for it to rotate back to the offshore environment. We're a little bit skeptical of that view, precisely because there are so many structural flaws to the global economy which we think could play out negatively for those investing abroad, particularly driven by potential resilience and strength in the rand. So we've seen that rand strength come through. We've seen the rand remain a lot more resilient, and we think that the offshore holdings at this point in time are likely to be hurt. We also suspect that the rand, in terms of its performance, could surprise people in its strength and resilience through the course of the next potentially 18 months and longer. So at this stage of the game, we're a little bit cautious about any offshore weighting. We think that right now equities abroad also not looking particularly enticing, perhaps a little more enticing if you had to look at it strictly on a valuation perspective, but not so much if you had to take future structural defects in those economies that still need to be worked through by the authorities, and which appear to be making very little progress.
Well, we've seen some very mixed economic data coming out over the past week, and many saying that we could see loose monetary policy remaining for longer in the United States, which should lead to a weaker dollar. You've been a proponent of a stronger rand going forward. Do you think it's possible we could break that 6 rand to the dollar level this year?
I certainly think it's possible. You know, those that have been calling for a weaker rand, I don't think have paid enough attention to the disparities between the kind of monetary policies being implemented abroad and the relatively conservative monetary environment that South Africa enjoys back home. And so that's a structural feature of the currency environment, often neglected and often not focused on enough, and we believe that those structural features remain in place, and if anything might strengthen through the course of the next 12 to 18 months, perhaps longer. So it's very much a case of how the US handles its fiscal crisis, whether or not that fiscal crisis continues to permeate through into ultra-loose monetary policy in the US, and how ultimately that draws back into an effect on the currency. Specifically, I'm referring to the dollar rand. Ultimately, if there is an ultra-loose monetary policy abroad versus a conservative monetary policy back home, you'll find that the bias will tend to favor rand resilience and strength.
Where does that leave the Reserve Bank then when it decides its monetary policy? I know we have a meeting coming up next week, so no change expected then, but What do you think the tone of that statement is going to be?
Well, that's a good question. I think if we have a look at the breakdown of currencies, it's important to note that the strength of the currency has come through predominantly against the dollar, less so against the likes of the euro and the pound and some other currencies. The point to be made is that a lot of the commodities that a lot of people are focusing on in terms of driving inflation, cost push pressures, are priced in dollars. And so to the extent that we are mitigating those inflationary pressures due to a rand that's strengthening against the dollar, but not strengthening that aggressively against the others, those that are fearful about South Africa deindustrializing because of the strength in the rand can look towards the rest of the trade-weighted rand basket and have some sense of comfort, and yet we still get the positive spin-off of the rand strengthening against the dollar and mitigating against those inflationary pressures. So on the whole, I think if one looks at it, we're in more of a sweet spot than a lot of people realize, and I think over time, the effects of this rand strength are going to become more and more pronounced and show up to be more favorable than a lot of people believe is the case right now.
Just finally, how would you see investor confidence progressing throughout the year? Because many thinking our market is going to move sideways. Would you expect investor confidence also to move sideways from this point?
Yeah, so QE2 and the conclusion of QE2 is a big unanswered question at this point in time as to what the ultimate impact of that is going to be. If the end of QE1 was anything to go by, there was a period of stagnation in equity markets, and then they started to erode and sell off. We don't see why this environment that we're in right now is substantially different. It may be a little different in terms of underlying economic indicators are perhaps a little bit stronger, but the point is that the structural flaws are still there, and if anything have gotten worse. And so ultimately we are fearful that there might be some volatility that flows through in the second half of this year, which if anything would see that investor confidence index deteriorate rather than improve.